When you're buying a house, one big choice you have to make is picking the kind of mortgage loan you want. Well, there are two main types: adjustable rate mortgage and fixed interest rate mortgage. Each has its good points and drawbacks. In this video, we will know more about these two mortgages and figure out which one is best for you. Make sure to watch the video till the end and subscribe to our channel. Also, press the bell icon to get regular updates. Welcome to Money Mindset. Let's get started. Understanding adjustable rate and fixed rate mortgage. An adjustable rate mortgage is a mortgage that has a rate that can alter over the course of the loan's duration. The frequency of these shifts typically fluctuates annually in response to the state of the housing market. However, the interest rate on some mortgages, particularly those with adjustable rates, may shift more frequently. The amount of interest that you are required to pay on your debt will fluctuate in accordance with any adjustments made to the rate. The initial interest rate that you pay on a mortgage that has an adjustable rate is typically lower than the interest rate that you would pay on a mortgage that has a fixed rate. This can be a suitable option for you if you want to start out by paying a lower amount each month. On the other hand, if you have a mortgage with a fixed rate, the interest rate will not change at all while you are making payments on the principal. This ensures that each and every one of your monthly expenses will remain the same. Your payment won't change regardless of how the housing market is performing, so you can budget accordingly. People who are more comfortable knowing exactly how much they will have to pay on their mortgage each month may look into fixed-rate mortgages. Your payment will remain the same regardless of whether the market is going up or down, which will make it much simpler for you to organize your budget. Advantages of adjustable rate mortgage. The biggest benefit of this type of mortgage with variable interest rates is that the interest rate is generally lower at the beginning. This means that at first, your amount will be less than it is now. This can help people who want a bigger loan or who might not have been able to get a loan with a set interest rate. Also, because the interest rate is tied to how the market is doing, if interest rates, in general, go down, these loans can have even lower rates. For example, let's say that someone gets a 30-year adjustable rate mortgage for $100,000. The interest rate for the first year is 5%. The interest rate rises to 6% after a year. If this person kept the mortgage for the full 30 years, they would pay a total of $153,980 in interest and the amount they originally took. But if they had picked a 30-year loan with a fixed interest rate of 6%, they would have paid a total of $154,880. In this case, the adjustable rate mortgage would have a cheaper monthly payment for the first year and less total interest over the life of the loan. Disadvantages of adjustable rate mortgage. The main problem with this type of mortgage where the interest rate changes is that you don't know how much your monthly payments will be in the future. Since the interest rate can change every year, it's hard to know how much you'll have to pay every month in the future. This lack of predictability can make it hard to keep track of your spending and plan for your future financial needs. Let's say the borrower gets an adjustable rate mortgage at first, and in the first year, the monthly payment is lower. But after the first year, the interest rate goes up to 8%. Over the life of the loan, the user would pay a total of $863,600 in interest and the original loan amount. If, on the other hand, they had chosen a 30-year fixed-rate mortgage with a 6% interest rate, they would have paid $774,400 over the same period. This example highlights that although the adjustable rate mortgage initially offers a more affordable monthly payment, it eventually leads to higher overall interest costs compared to the fixed-rate alternative. Advantages of fixed interest rate mortgage. When you get a mortgage with a fixed rate, you will always know precisely how much your monthly payment will be, which can be one of the most beneficial aspects of this type of loan. This is because the interest rate remains the same during the loan and does not alter at any stage. As a direct consequence of this, you will be in a position to accurately determine the total amount that you will be responsible for paying every month. Another advantage of this arrangement is that your regular payment will remain unchanged independent of any potential future increases in the interest rate. This constancy can be of major benefit to borrowers in managing their home loan expenses, particularly if the borrower's income does not change significantly throughout the loan. To put it another way, having a mortgage with a fixed rate provides you with the peace of mind that comes along with knowing that your monthly payments will not fluctuate regardless of what the state of the economy as a whole does. Disadvantages of fixed interest rate mortgage. One disadvantage of house loans with fixed interest rates is that they often begin with a higher interest rate than loans with interest rates that can alter over the loan's term. Therefore, the payment for the first month is significantly higher than it normally would have been under these circumstances. It may be difficult for those who do not have a lot of money to deal with the problem at hand. To illustrate this point, let's imagine that a borrower decides to get a mortgage loan with a fixed interest rate of 8% for the whole term of the loan, which is 30 years. In this scenario, the monthly payment would be $1,200, which would make it difficult for certain customers to keep up with their financial obligations. In addition, regardless of whether or not future interest rates ended up being lower, the monthly payment would continue to be the same. This indicates that the consumer might wind up paying more than they need to, even though reduced interest rates might save them money overall in the long run. Making a choice. Adjustable or fixed rate mortgage. Choosing between a mortgage with an adjustable rate and one with a set rate can have a big effect on your future finances. Your choice should depend on your current financial position, your plans for the future, and how comfortable you are taking financial risks. An adjustable rate mortgage could be right for you if your main goal is to have a lower monthly payment in the short term and you don't mind not knowing how your monthly payments might change in the future. Initial interest rates on adjustable rate mortgages are lower, so monthly payments are also lower. This can be especially helpful if you're just starting your job or want to buy a more expensive home. It can help you pay less for handling your home loan. The interest rate on an adjustable rate mortgage, on the other hand, can go up over time. This means that your monthly payment could also go up, making it harder to plan and budget for your future financial needs. On the other hand, a fixed-rate mortgage might be better if you want a stable monthly payment and are willing to pay a bit more for the peace of mind it brings. When you get a fixed-rate mortgage, the interest rate stays the same for the whole loan. Even if your income doesn't go up over time, this predictability can help you prepare and plan for your money needs. Also, if you plan to stay in your home for a long time, you might be better off with a fixed-rate mortgage. It keeps you from having to worry about what will happen if interest rates go up. But if you're thinking about selling your home soon, an adjustable rate mortgage might be a better choice. Your home might be more appealing to buyers if the first monthly payment is lower. That's all for today. Remember, understanding the pros and cons of both types of mortgages will help you make an informed decision that aligns with your financial goals. Whether you prioritize flexibility or stability, choosing the right mortgage can contribute to a successful home buying experience. Give this video a big thumbs up and subscribe to our channel for more amazing videos. Thanks for watching.